How do you sell inherited property to a family member? To sell inherited property to a family member, treat the buyout like a real estate sale, confirm who has authority, order an independent appraisal, resolve liens and the mortgage payoff, use a written purchase agreement, and close through a title company, escrow company, or real estate attorney, depending on the state. A family sale is not just a family favor, it affects title, taxes, financing, and the relationship between heirs. I'm Rhett Fruitman, co-founder of Inherited Property Match. My background includes City Private Bank, CBRE, and helping families navigate inherited property sales across the country. This is general information, not tax, legal, financial, or real estate advice. Before you sell inherited property, speak with a CPA, and when probate or trust administration is involved, an estate or probate attorney. How do you price a family buyout at fair market value? Fair market value is the price a willing buyer would pay a willing seller when both sides know the important facts, and in a family buyout, an independent appraisal is usually the cleanest way to document that number. Can you sell an inherited house to a sibling below market value? Yes, if everyone with authority agrees and the deal is properly documented, but the discount may be treated as a gift and may require IRS Form 709 reporting. That does not always mean a gift tax bill, but it is a CPA question before closing, not after. Fair pricing also protects the family. If one heir buys a house worth $600,000 for $450,000, the other heirs may later feel they gave away value. An appraisal gives everyone a defensible starting point. How do you calculate a sibling buyout on inherited property? To calculate a sibling buyout, start with the appraised value, subtract the mortgage payoff, liens, agreed credits, and estimated closing costs, then divide the net equity by each heir's ownership share. Here is a simple example. If the inherited house appraises for $600,000, the mortgage payoff is $40,000, and estimated closing costs are $10,000, the net equity is $550,000. If three siblings own equal shares, each share is about $183,333. The sibling keeping the house would need to buy out the other two shares, or about $366,666, plus handle the mortgage payoff and closing costs. The buyer also needs a real financing plan. Most family members cannot simply take over the deceased owner's mortgage without checking lender rules, refinance options, assumption rights, and due-on-sale issues. Who has authority to approve the sale? The person who can approve a family sale is usually the successor trustee, the executor or personal representative, or all recorded co-owners, depending on how title is held. If the property is in a trust, the successor trustee usually signs for the trust and must act in the best interests of the beneficiaries. If the property is in probate, the executor or personal representative may need letters testamentary or letters of administration before a title company will close. If the property has already been distributed to multiple heirs, the co-owners generally all need to sign for a voluntary sale of the whole property unless a court orders otherwise. This is why title matters more than family agreement. A handshake between siblings does not fix missing probate authority, a deed problem, or a beneficiary who was never properly notified. Can an executor or trustee buy inherited property from the estate? A trustee or executor may be able to buy inherited property from the estate, but it is a conflict of interest transaction and must be handled with full transparency. This is often called self-dealing. It does not automatically make the sale impossible, but the fiduciary has to prove the deal is fair, disclosed, and properly authorized. That usually means an independent appraisal, written disclosure to beneficiaries, separate legal advice for the fiduciary as buyer, and approval under the will, trust, beneficiary consents, or court order when required. If the person in charge is also the person buying the property, slow down. That is exactly the situation where rushed paperwork can turn into personal liability. What financing and tax issues matter in a family buyout? The main financing and tax issues are cash or loan approval, the existing mortgage payoff, stepped-up basis, capital gains, possible gift tax reporting, taxable interest on seller financing, and state or local property tax reassessment. Cash is simplest. When cash is not available, families may use a conventional mortgage, refinance, estate or trust loan, or seller financing. Seller financing should use a written promissory note, clear payment terms, and a secured deed of trust or mortgage. The interest paid to the selling heirs is generally taxable income, and the note should be reviewed for imputed interest and applicable federal rate issues. For taxes, inherited property generally receives a basis tied to fair market value at the date of death or an alternate valuation date when that applies. If the sale price is close to that inherited basis, after selling costs and adjustments, the capital gain may be small. But a below-market sale can create gift reporting issues, and property tax reassessment rules are state and local, not federal. Check those rules before anyone signs. What title problems and documents do you need before closing? Before closing a family buyout, order a title search and collect the documents that prove authority, value, payoff amounts, and written consent. Family deals can still be stopped by unpaid property taxes, mortgages, HELOCs, reverse mortgages, HOA balances, judgment liens, estate creditor claims, missing probate authority, or an old deed problem. Those issues do not disappear because the buyer is a relative. The core documents are the death certificate, trust certification or trust excerpts, letters testamentary or letters of administration. If probate is involved, the current deed, the appraisal, the title report, mortgage payoff statement, property tax records, purchase agreement, and any promissory note, deed of trust, mortgage, or written beneficiary consent. What if siblings cannot agree on the buyout? If siblings cannot agree on price, timing, or financing, use mediation, set a hard financing deadline, or move the property to the open market. Partition is usually the last resort. An occupying sibling should also have a written occupancy agreement that says who pays taxes, insurance, utilities, repairs, and what happens if the buyer cannot close by the deadline. Without a deadline, one heir can unintentionally hold the whole family hostage. The bottom line is simple. Treat the family buyout like a real transaction, price it fairly, document every major decision, and keep title, tax, and financing issues visible from day one. If you inherited property and need help finding a broker who understands estate-related sales, Inherited Property Match can connect you with a vetted broker experienced with inherited property. The match is free.